right, I'd like to welcome everybody. Today is Friday, April 21st. Our topic today with our SBDC webinar here is understanding business cash flow and financing options. We are excited to have one of our reps out of our District 5 with the SBDC out of Pocatello. Claudia Allen with the SBDC is going to be presenting today, and we are recording this. We will have it up in hopefully by this weekend, or if not, first part of next week. We'll have it on our iictr.com website for if you want to follow up on anything that's mentioned there. If you do have any questions, we ask that you put them in the chat box, or hold them till the end. We will be ending just a couple minutes early and have a spot at the end. We always answer any questions that are available at the end. So with that, we will turn the microphone and the presentation over to Miss Claudia Allen. It's all yours, Claudia.
Thank you, Brian. Can everybody hear me okay?
I think you're sounding great.
Yep, great. Good morning, everyone. Thank you. I'm excited to be doing this. This is my first webinar that I've ever done, so please be patient with me. And we will, like Brian said, take questions at the end, because I know there's a lot of stuff that we're going to cover in a very short period of time. For those of us that don't know about the SBDC, all our services are free and will always be free, and we can help you understand your cash flow and financing options. So please call us if you need any help. So let's get right into it. What is cash flow exactly? Well, cash flow is the revenues that a business generates and collects compared to the expenses that they put out over a fixed period of time. And that's something that's really what sets a cash flow statement apart from everything else, and we're going to go into that in a little while. It is, I think of it as a snapshot, like you're taking a picture of your company right at that moment, and it's the money that you actually have in your company, in your bank account at that time, and not what's owed to you, because we know we all have accounts receivables that people owe us. That is not counted in a cash flow because you don't have it in hand and you don't know if you're really going to get that money. It's money. The money that we're talking about is money that's generated through your sales of your product, financing, so if you have any financing through a bank, and returns on investments, if you've got any investments that you've put your money into. Expenses can be anything from supplies, services rendered, utilities, payroll, taxes, things that we all have to pay. So I'm going to talk a little bit about the difference between a cash flow statement.
I'm on. All of a sudden, it worked. Thanks.
Okay, I'm going to talk a little bit about the difference between a cash flow statement, a profit and loss statement, and a balance sheet. Basically, the cash flow statement shows exactly how much money a company has received and how much it has spent over a period, and it's typically 1 month is how they do cash flow statements. So you have 12 in a 1-year period. It captures the current operating results and changes on the balance sheet. And we're going to talk about the balance sheet in a little while because it is a lot different than a profit and loss statement in that regard, because it'll show increases or decreases in your accounts receivable and accounts payable, but does not include non-cash accounting such as depreciation and amortization. A cash flow statement is used to determine the short-term viability and liquidity of a company. So that's what the banks are looking for. Are you able to pay off whatever loan we're going to give you? And it's specifically how well it is positioned to pay the bills and its vendors. Do you have enough money in there to pay all the bills that you've got coming up in the long run? An income statement, which is also called a profit and loss, which we're all more familiar with, is the most common financial statement, and it shows a company's revenue, all the revenue, including your accounts receivable, your total expenses, including non-cash accounting such as depreciation, which we all know we need at tax time to reduce our tax liability. It's traditionally over a 1-month period, or you can also do a yearly profit and loss. A profit and loss is used to determine the financial performance of a company, specifically how much revenue it made, how many expenses it paid, and the resulting profit or loss from the revenue and expenses. I'm always surprised when I go into a client's business how many owners of a company never run a profit and loss statement or a cash flow statement. I always run one as soon as I go into a business if I'm helping them with their QuickBooks, because a profit and loss, you can usually pick out errors on your posting, like a bookkeeper's posting things to the wrong thing. Sometimes I'll see credit balances where there shouldn't be credit balances, so you know they've entered things wrong. But the other thing is, it scares me how many owners are not aware of their cash flows and their revenues and their expenses. So if you are a business owner, please run one of these. Take a look at it. If you don't understand it, call us here at the SBDC, and I'd be happy to sit down with you and talk to you about that. The balance sheet is what I call the magic, because I don't think I could do a balance sheet without QuickBooks, because these numbers always magically appear. And it is called a balance sheet because all your assets and your liabilities will always total your equity, which is your owner's equity and your net income. And we'll talk about that a little bit more when we get into each individual financial statement. So now we're going to look at a cash flow statement. So this is for, can everybody see this okay on their screen?
I think so.
Okay.
Yes.
Great. So this is for a company, the year ending December 31st, 2008, and their cash at the beginning of the year was $15,700. Now all the cash receipts, not accounts receivable, but the total cash that they received from customers that year was $693,200. And then we go into what they paid out. So you have inventory, cost of goods, general operating and administrative expenses, your wage expense, which of course is always one of your higher expenses, your interest expense, that would be interest on loans, so forth, and your income taxes, which we all unfortunately just all paid this week. So your net cash flow from operations is your cash receipts minus your expenses. So your net cash flow is $147,900. Then, and this is cash flows, I should have said before, are always broken up into these three parts: operations, investing, and financing activities. So now we go into the investing activities. They have sold some property and made some money on it for $33,600. But they also purchased new equipment. So they probably sold an old piece of equipment and bought a brand new one, and that was $75,000. So the net cash flow from their investing activities is a negative $41,400. Next, we go to the financing activities and the repayment of loans, because probably they financed that piece of equipment that they bought, was $34,000. The dividends that they paid out, so obviously they have investors in their company, they paid out $53,000 in dividends, so the net cash flow from financing is $87,000 in the negative. So the net increase, when you take your positives and your negatives, was $19,500. And the cash at the end of the year, when you take that beginning balance, is $35,200. So there is your company snapshot of this company at the end of the year. Now we're going to look at a profit and loss. This is a financial statement that summarizes the revenues, costs, and expenses incurred during a specific period of time. And it's usually, some people like to run it monthly. I have to run a civic organization that I do the books for. I have to run them monthly to show to the board. Most businesses will run this once a year, every fiscal year, to give to their accountant and to see if they should keep the doors open or not. These records provide information about a company's ability or lack thereof to generate profit by increasing revenue, reducing costs, or both. And this is one of the things I love doing when I go to a new client and run their profit and loss, is in a heartbeat you can see, wow, you're spending too much money on repairs and maintenance. So you need to either get new equipment, which will benefit you in the long run, but this is a really good place to see how to increase your net income. So I think most of you have seen one of these, so I won't spend a lot of time because I know I only have 5 more minutes before questions, and we still have to get into financing. But this just shows your income, your cost of goods sold, which always come off the top of your income. So your gross profit was $27,000, and then you've got all your expenses, which come up to $2,244, which, boy, I'd like to be part of this company. They're making some good money. So your net ordinary income is $25,128. And then you have other little expenses like that weren't in your regular expenses. So your net income for this year was $25,042.32. Now we're going to look at a balance sheet. This is typically, every bank when you go in for financing is going to want to see your balance sheet and your profit and loss statement. This kind of tells them if your company's really making any money and if they're viable for a bank loan. I know if you're just starting a brand new company, you're not going to have these unless you're buying a company. And I always have my clients get these from the seller of the company so that we can look through them, put them in a spreadsheet, see where they're going, especially try to get a 3-year history so you can see, is this company growing or is it shrinking? And if it's shrinking, it's not certainly a company that you would want to buy. So on the balance sheet, it summarizes a company's assets, liabilities, and the shareholders' equity, if there are shareholders, or the owner's equity at a specific point in time. So usually you would run this at the end of the year. These 3 balance sheet segments give investors an idea as to what the company owns and owes, as well as the amount invested by shareholders. And it's always, the reason they call it a balance sheet, because your assets always equals your liabilities plus your shareholders' equity. So you can see the assets is, of course, all your checking accounts and any savings accounts that you have. And so your total checking, some of them are in the negative, not sure why, that's not a good sign, but your total checking and savings is $5,083.51. Then you have your accounts receivable. These are the ones that you know that you've billed your customers for. Hopefully you're going to get them. So that is considered an asset because it is money that hopefully eventually will come into you. And then you have undeposited funds that you haven't put in the bank yet. So your total assets are $78,685.37. Then you have your fixed assets, which are your furniture, equipment. In this case, they have landscaping equipment. It's a landscaper. So your total fixed assets are $21,598. So your total assets for your company is $100,283.83. Then we go down to the liabilities and equity. Your current liabilities, which is your accounts payable, bills that you have but you haven't paid yet, $773.06. Payroll liabilities, because we all know that you take them out of people's checks every pay period, but you don't pay them until the 15th of the next month. So there's a liability of $459 for your payroll taxes. So your total liabilities are $1,232. Then we go into the owner's equity, and this accrues from the beginning of the business until they shut the doors. So that's $76,473, and then your net income is $25,000. So your total equity, total liabilities and equity is $100,283.83, and there's your magic. It matches your total assets. Now, real quick, we're going to go into some financing options. The first one, friends and family. I try to steer people away from that. If you can see my little quote from Shakespeare, it's a good way to lose your friends and family if you don't pay them back. Banks are always a great source. The SBA, which those of you that have never gotten an SBA loan, you do typically have to go through a bank. The bank makes the loan, but the SBA banks and guarantees that loan. So it's very favorable for yourself. It's a lower interest rate, and the banks love it because it's guaranteed. If you default, then the SBA covers that loan. Another option that's getting a lot of popularity here in Idaho is the Idaho-Montana CDC. They typically will give you a loan if a bank turns you down. Maybe you don't have enough collateral, maybe you don't have enough credit history. The Idaho-Montana CDC will give you a loan for 2 years. Their target is 2 years, and in that 2-year period, they try to get you ready to get a bank loan. Their interest rate is a little bit higher because they consider you a higher risk. But then after that 2-year period, after working with you and giving you tools on how to better present yourself to the bank, then the bank will typically take over that loan. Banks typically require at least anywhere between 10 and 20%, but I always tell my clients, count on 20% down, some skin in the game with either cash or some form of collateral. And one thing people are always surprised about is you do have to use your personal credit score. So if you have 500 credit score, I wouldn't recommend going to a bank. That's when you borrow from friends and family because they're not going to look at you. The SBA loans are typically 7 to 10 years for working capital and equipment. And if it's real estate, they will go up to 25 years. And interest rates through the SBA typically start at 4.25%. So as you can see, if you go to a regular bank, they're usually about 6-7%. So it is quite a big savings. And we work really closely with the SBA. We're also funded by the SBA, and we can certainly help you get in front of the SBA and write the business plan for the banks and the SBA. And that, I went 1 minute over, but now we have time for questions.
Anybody have any questions? Let's see.
So somebody just asked a question. Have you had any feedback on online lenders? I had a client with a terrible experience. Yes. I had a client that was actually going to go through one of those online vendors because he got in some trouble and didn't pay his payroll taxes. They are targeting people that have bad credit and don't have a lot of collateral, and they are going to charge you, they're going to charge him 25% interest, which is just highway robbery to me. You might as well just go to one of those check and loan places. So yes, I don't recommend going through online lenders. Go to a bank that you already have a relationship with. Go to one of your local banks. They're going to be more apt to help you if you live in the same town. Does that answer your question?
Barbara, yes, thank you.
Is anybody out there? Oh, yes, thank you.
Okay.
And more questions?
Tell me what the process is to go through like the SBA. What's the time process to do an SBA loan?
So typically, if you come here first and we write a business plan, it'll take us a couple weeks to get it perfect, and you take it back to your bank. They typically will present it that same week to the SBA. Now, the SBA only meets usually once a month unless there's special circumstances, and Samantha here at our local office can do it faster. But they typically, their board reviews all the loans once a month, and you typically will have an answer within a week. So the whole process can take anywhere from 2 weeks to 6 weeks, depending on the timing of when the board meets with the SBA.
Okay. Very good. Ann has a question. Can you go over owner's equity again?
So I told Ann she wasn't allowed to ask questions, but
only I could ask a question.
she was going to ask who is your boss. I'm going to call her and complain about you. For those of you that don't know, Ann is my boss. So, Ann, do you have a specific question on owner's equity?
Yeah, I'm just never exactly sure what that means. Like, is there you have owner's equity, which is sort of like, is it just a placeholder, or how do you understand that?
It's typically all the money from the day that you started, all the money that is not spent out in either expenses. So like your owner's draw will go into it. All the money that you could have put in your pocket that didn't go out in typical expenses builds up as equity in your company. And it also can be if you have shareholders and you have dividends that you didn't pay out, investors that have invested money into your company and you haven't spent it by buying equipment, that all builds up over time. And you will see that owner's equity will grow every year and just get larger and larger, hopefully.
So looking at it as money that the owner could have taken out but didn't.
Correct.
Like reinvesting into the company, so to speak.
Correct.
Okay.
Mm-hmm.
I like the comment there that Barbara put. I think of it like net worth of the business. So in looking at those financials that you have, if you're trying to determine a valuation of what the company may be worth, what are some things you can look at on those financials to determine what a business would be worth?
Well, I think the first thing I always look at is the profit and loss. So let's say you're generating $100,000 in sales, but your cost of goods sold are $80,000. There's a big red flag. That only gives you $20,000 working capital. And that's not a lot to be running a company by the time you pay payroll. So right there, that tells me you're probably not charging enough for your product because it's costing you 80% to make whatever you're making. So you need to either increase your sales or decrease your expenses, get a new supplier. So that's the first thing I think people look at. And like I said, look at a historical. Is that business growing in value over time? Or are you losing money every year at, let's say, 10%? Because in 5 years, you're not going to have a very viable business if that's the case.
Yeah. So I have a company that I'm working with that's wanting to look at selling the business. The problem is that he's using any extra cash that's in the business to pay off all of his loans and debts and things like that. So his cash, his books do not look that good because he's eliminating all of the debt that he's got over the last couple of years, trying to get all that paid off. What can you, I mean, if you're trying to determine a valuation of a company, the company's profitable, but yet it doesn't look like it on the books because of trying to just pay off some of the debts. How do you
So Brian, is he trying to pay off the debt? Is he trying to pay off the debt, personal debt or business debt?
A little of both, but probably more, I think I would guess personal.
Okay, so that's going to be considered an owner's draw. And the bank will see that that's money that could have been kept in the business. Oh, okay, Barbara's going to address this in a minute too, but the bank is going to see that that is money that would have been part of the net worth of the business, but he's drawing it for personal. So they'll take that into consideration. If it is paying off debt for the business and it's creating a hardship on the business, then that's a red flag. But Barbara, do you want to add to that?
Yeah, so I used to do appraisals, mostly farm appraisals, and that's a little bit different thing. But I always ask the business person to define exactly what it is that they're selling. So number one, they're probably not going to the balance sheet. They're not selling net cash. They're not selling the accounts receivable. They're not going to be selling any of the debt. So what they're selling is, number one, the assets that the business has, and those may be fairly close on the balance sheet, but we usually, if there's quite a bit of assets, either real estate or equipment, you want to get a updated asset value on those. And then on the other end, the income versus the expenses, if the business isn't profitable, there's not going to be any value there. But if it is a profitable business, been profitable for a while, there's what we can calculate as the present value of that future income stream. And we always make adjustments for what the owners are paying themselves.
Yeah. Okay. That might give me some better insight to go with them. He's trying to evaluate, what a good selling price for his business would be. But, when I sold my business, it was, 3 to 5 times the earnings, but it's hard to come out with what his real earnings are when he's paying off the debt. So thank you. That's
any other questions?
Good advice.
Thank you, Barbara.
You bet.
Is there any other questions?
All right. Looks like we've covered everything that's in the chats as well as any of the questions. So great job, Claudia. So appreciate your preparation. Absolutely a great content in this, and I think that every business out there, whether throughout different portions of their life cycle of their business, definitely needs to hear these type of things. So great job. Thank you so much. We will have this webinar up on our iictr.com website. If you have any questions you want to refer back to it, it'll be up there. If not today, first thing on next week. Next week's webinar will be on driving employees towards success. We've got a great presenter next week that will be talking about driving your employees and how do you make them successful. And the more successful your employees will be, the more successful your organization will be. So look forward to having that webinar on the 28th. Thank you, everybody. We will be seeing some of you next week in Boise at the SBDC meetings, and look forward to that. Have a great weekend, everybody. Again, thank you.
Thank you, everyone.
Thanks, Claudia, for your preparation. Great job.
Okay, thank you. Bye-bye.